Hello everyone and welcome back to the channel. Today we're diving into one of the most famous financial disasters in history, the Great Depression of October 1929. But instead of just looking at the history, we are going to explain why it happened in a very simple way. So if you're interested in understanding the technical side of what caused this big crisis, stick around. And before we begin, don't forget to hit the subscribe button and give this video a thumbs up to support the channel. Alright, let's get started. The Great Depression was one of the worst economic crises in history. It started in 1929 in the United States and lasted until the early 1940s. During this time, the US economy and much of the world's economy came to a standstill. Millions of people lost their jobs, many businesses went bankrupt, and banks closed their doors, taking people's savings with them. To understand just how bad it was, let's look at some numbers. By 1933, unemployment in the US was at 25%. That means 1 out of every 4 people didn't have a job. Compare that to today, when unemployment is usually around 4 to 5%, and you can just see how difficult things were. It wasn't just factory workers or farmers who lost their jobs. People in all types of industries suffered. Families faced incredible hardships. Many had to leave their homes because they couldn't afford to pay rent or their mortgages. Homelessness became a huge problem, and people began setting up makeshift communities in public parks or empty lots. These areas were called Hoovervilles, named after President Herbert Hoover, who many blamed for this crisis. But the Great Depression wasn't just a problem for the US, it spread to other countries as well. Because the world's economies were linked through trade, the collapse of the American economy affected countries in Europe, Latin America, and even Asia. But what caused this crisis? One of the main reasons was the stock market crash in October 1929. This crash didn't just happen in one day, it was actually a series of events. The most famous ones are Black Thursday and Black Tuesday. Black Thursday happened on October 24, 1929. On this day, the stock market started to fall rapidly. People were already nervous because stock prices had been going up and down widely in the weeks before. When prices began to drop fast on Thursday, investors panicked and started selling their stocks to avoid losing even more money. At the time, there were no automatic system to stop trading like there are today. So once the selling began, it quickly spiraled out of control. The market lost billions of dollars in just a few hours. Some major bankers tried to step in and calm things down by buying large amounts of stocks to show confidence in the market. This helped a little bit, and the market stabilized for a few days, but the panic wasn't over. Just a few days later, on Black Tuesday, October 29, 1929, the real crash happened. This was the day when the stock market lost almost 12% of its value in one single day. Investors rushed to sell, and there were no buyers to stop the crash. Billions of dollars were wiped out, and many people lost everything they had invested. So why were people investing so much in stocks in the first place? During the 1920s, the stock market seemed like a sure way to get rich quickly. Many people started borrowing money to buy stocks, expecting the prices to keep rising. This is what we call buying on margin. Essentially, people were buying stocks with money they didn't have. This made the crash even worse. At that time, many banks had also invested in the stock market or gave loans to people who were buying stocks. When people couldn't pay back their loans, the banks lost money too. And when people heard the banks might be closing, they rushed to take all of their savings. This caused what we call a bank run. A bank run is when a lot of people try to withdraw their money at the same time. But banks don't keep all of their money in one place, they lend it to others, so they ran out of cash and many banks had to shut down. Millions of people lost their savings overnight. The Great Depression also got worse because of problems in international trades. Many countries started to put tariffs on imported goods. A tariff is like a tax that makes things from other countries more expensive. The idea was to protect local businesses, but it actually made things worse. Trade between countries slowed down, and this hurt economies even more. One of the reasons the Great Depression lasted so long, it was because it wasn't just one thing that caused it. There were actually many problems happening at the same time. The stock market crash, the bank failures, and the drop in trade all worked together to keep the economy down. It also took a long time for governments to figure out how to fix things. They didn't have the same tools to control the economy like we have today. For example, they didn't have the strong social programs or unemployment benefits to help people who lost their jobs. Now let's talk about 3 curious facts about the Great Depression. Number 1, monopoly was created during the Great Depression. Yes, The board game Monopoly that we all know was first sold during the 1930s. It was created to help people feel like they could still make money, even if it was just pretend money. Number 2, people used things like scrip instead of real money. Since banks had no money, many local governments and businesses started to print their own money, called scrip, to help people buy things. Number 3, the Empire State Building was completed in the middle of the Great Depression. Even though times were tough, one of the most famous buildings in the world, the Empire State Building, was finished in 1931. But guess what? For the first few years, most of its offices were empty because businesses couldn't afford the rent. The Great Depression didn't end overnight. It took years of effort and change. One of the main factors that helped bring the US economy back to life was the introduction of President Franklin D. Roosevelt's New Deal programs in the 1930s. These programs created jobs, built infrastructure, and reformed the banking system. But it wasn't until the start of World War II in 1939 that the economy fully recovered. The war boosted manufacturing and created millions of jobs as the US ramped up production to support the war effort. By the 1940s, the Great Depression was finally over and the economy began to grow again. To sum it up, the Great Depression was a result of many different factors. The stock market crash, bank failures, and international trade issues all played a part. Even though it was a hard time, people found ways to get through it. And as we have seen, some interesting things like Monopoly and the Empire State Building came out of it. Thanks for watching. If you found this video helpful, don't forget to hit the subscribe button and leave a comment below. And stay tuned for more videos like this. See you in the next one!